Well, let's get this show on the road. All right, today I'm here with Sam over at Elevations Credit Union, and we just want to talk about a couple of quick things on, how to get pre-qualified, how to tell how much house you can afford, and a few of those other things. Sam is definitely one of the great guys that I like to refer all my clients to because over there at Elevations Credit Union, they can definitely take care of most all of your lending needs when it comes to a house. So, how's it going today, Sam?
It's going great. How about you, Brian?
Oh, doing good. Definitely busy in this crazy market. Listing inventories down, refis are way up. So trying to get a hold of a lender and get them on, to answer phone calls is tough. So, that's what I really appreciate about you.
I appreciate the opportunity. It has been a busy year, but it's been a busy decade here in Colorado, right?
Yes, it has. So, yeah, a lot of the times, talking with clients and worried, they're worried about do they qualify for a home or, I only want to spend this much money or, what does all these things kind of mean? So, maybe let's talk about, a little bit of how to pre-qualify yourself, and see, how much loan can you afford or what does that all look like? Talk a little bit about, you know, just what's involved in a mortgage payment.
I don't recommend that you try to pre-qualify yourself. Um, I recommend that you talk to a professional, somebody with experience who knows what questions to ask. But if you want to do some, you can do some self-checking just to see if you're, in the ballpark. Most of the places now we will look at houses will have a payment calculator on there, and you're usually able to manipulate the down payment and get some sort of idea of what the principal and interest would be. And then if maybe they have the taxes, property taxes incorporated in there. And if not, normally the taxes are somewhere on whatever you're looking at, whether it's a listing or a Zillow or whatever thing you're looking at, you'll be able to find the taxes. And then insurance, that's going to vary from the size house you have, the age house you have. Homeowners insurance, I would say anywhere from 125 to 175 per month for a single family home. So you can probably get close to the total payment. If it's a condo townhome, look for the HOA amount, add that in, and then just take your homeowner's insurance estimate down to around $40 or $50 a month, since your HOA will be carrying a master policy. If you're putting less than 20% down, there's going to be PMI or private mortgage insurance involved, and how much that is determined by your credit score and how much you're going to put down. If you're trying to do this at home, which I don't recommend, other than you can, like I said, you can get a general idea of what, if you're in the ballpark. I mean, I can go through how you calculate it on various down payment amounts, Ryan, but I don't know if you want me to
Well,
go
we
into
don't
that
want to
much
get too
detail.
carried away and, cerebral on people here, but, maybe just, if we talk a little bit about, what are the different types of loan programs you have out there, 3%, 5%, 10% down, 20% down, what kind of programs does Elevation have, for those kind of people?
Well, I really love the first time buyer program, conventional program for people with excellent credit.
Mm-hmm.
It's 3% down, and the interest rate is really nice and low on it. The PMI is low on it. There's a little bit of home buyer education required, but it's all online and it's free.
Okay.
Might take an hour. That's my favorite one, 3% down.
I like that one a lot too.
Yeah, and if they need down payment assistance, then I recommend the Colorado Housing and Finance Authority, or CHFA,
Mm-hmm.
we work with. CHFA does what they'll do is a soft second on a conventional loan to provide you with some down payment assistance. You still have to come up with a minimum of $1,000
Mm-hmm.
investment, and it's usually more than that by the time you add up closing costs and prepaid expenses, et cetera. But if 3% is too much, then CHFA is a great way to go. And of course, if you're a veteran, VA loan is fantastic.
Awesome.
No money down, great loan if you're a veteran. And we have just about everything. At Elevations, great jumbo products for higher end homes. And then we also do, like I said, a lot of the first time buyer stuff as well, kind of the whole gamut.
Perfect. So you were talking a little bit about conventional, the
Mhm.
3% down conventional loan. Explain the
Yeah.
difference between, a conventional one and a normal FHA type loan. What are the borrowers, going to have to jump through in the hoops? I know from the real estate standpoint, if we get a pre-approval letter from with its FHA, well, we know that, there's a lot of the dates and deadlines that just go right out the window, and the buyer's pretty much protected. They get all their earnest spending back, no matter if they cancel it right at the last second or not, that kind of stuff. A lot higher scrutiny on the inspection, those kind of things. But yeah, what does that mean, from the lending standpoint, the differences?
Well, it sounds like from the real estate community, you guys prefer conventional.
Yes, we do.
um, yeah, and so the basic difference is, a conventional loan uh, doesn't really involve the government. Um, so where FHA is a federal housing authority insures the loan. Now FHA, the minimum down is 3.5%. And of course, FHA is a little tougher on appraisals, and that can be an issue with older homes.
Mm-hmm.
With newer homes, it's hopefully not going to be an issue for you guys. But on the reason I prefer conventional over FHA is that it really depends on the situation. But for it seems like most of the clients in Colorado have excellent credit, and if you have excellent credit, your terms get much better on the conventional side than the FHA side, because the interest rate and PMI rates are very dictated by your credit score on the conventional side. On the FHA, it's more of an all-encompassing, everybody can come get a loan kind of a thing. Now, that's not true, but, you still have to have a decent credit score. So, for us, it's a minimum of a 640. If you have a 640 or 660 or something like that, the FHA starts to look pretty good by comparison. And the reason that is because FHA, it's not as customized. The interest rate is not affected so much by your score, nor is the mortgage insurance that FHA charges. So there's you get into certain credit scores and you do a back and forth comparison. FHA always comes out with a great low interest rate, but by the time you add the mortgage insurance to it, that's where the conventional starts to look better.
Okay.
So if you have a great score, we always try to go conventionally first, because the mortgage insurance will be much cheaper. With FHA, you pay 1.75 up front at the closing table. You essentially give the FHA half of your 3.5% down payment at the closing table. So
Yeah.
we never want to do that to people, right? We want them to be able to sell in the future, make a little bit of money, and buy the next home. Well, that's kind of getting them off on the wrong foot, if they go FHA. But if they have lower scores and they want to buy a home, the FHA compares really nicely.
All right. Yeah, that's great. Let's talk a little bit about, debt to income, DTI. That's a big thing that's around a lot. How is that, figured basically? What kind of, like, how would somebody figure out what their debt to income?
Okay, then best method is to call their professional lender.
Yes, of course.
That'll be the least dangerous way. But again, for a self-check, for a W-2 type employee,
Mm-hmm.
Your base salary before taxes are taken out is the safest way to go.
Okay.
And you take that, divided by 12, it's your monthly salary. Now, the debt to income is comprised of your monthly debt payments, which would be the new house payment, which we talked a little bit about,
Mm-hmm.
how you figure that out, and then whatever your other minimum payments that are required on your consumer debt. So things like car loans, car leases, student loans. If they're in deferment, put a 1% payment in there to calculate your payment, because that's what we'll do. Credit cards, if you pay them off monthly, maybe throw a $25 fee in there because that'll be probably a minimum payment or something like that. So
Yeah.
all those plus the house payment divided by your gross monthly income gives you the debt to income. And if you're above 45%, then you're kind of in the danger zone a little bit of creeping into your max.
Okay.
We like to see around 40% debt to income, but we can usually get 45 and up a little bit approved.
Yeah, that's good. Good to know. Definitely teetering every once in a while on where the debt incomes are based on income. So that's definitely a good idea to keep in the back of your mind. Get things paid off. A lot of times, if you want to have a higher, payment or purchase ability for sure. So I like that. Yeah, jumbo loans. Tell me a little bit about those. Now, is that something that no matter what you got to put 20% or 25% down, like a lot of places, or what kind of programs do you have for the other side of things?
Yeah, that's a great question. So jumbo lending in Boulder County, this year will be what starts at roughly 655,000 for loan amount. So if you need to borrow more than that, typically jumbos do require 20% down for like a 30-year fixed jumbo. In Boulder County, if you've got a purchase price of about 818 or higher, and you want a fixed rate loan, you need to plan on putting 20% down, going the jumbo route. If you have less than that to put down, we do have a niche program at Elevations that it's a 7-1 ARM that we allow as little as 5% down on a jumbo loan. Up to $1 million. So that is a niche program of ours, and the typical user of that is someone who's got high income, but for whatever reason they don't have a 20% down payment, or they don't want to liquidate their other investments, and they think, oh well, it's fixed for 7 years, the interest rate, I'm going to be in and out of this house. There's all sorts of reasons people choose that, but it's a real niche for us, and it helps because the price of homes here, I know you've noticed, are quite high. So you have starter homes in Boulder at 700,000. I mean, right? So we have a good bit of clients who end up in that jumbo world, but aren't like ready to liquidate their lives in order to come up with a 20% down payment. And it's a good little niche for us.
Yeah. And after 7 years, if the market, stays steady at 3-5% increase a year, which of course has been doing way better than that lately, hey, you're probably going to have dang near 20% equity in there anyway by the time you need to refi. So
right. Good point. You can refi at any time, that you can get into a jumbo. You can refinance into a fixed rate out of the ARM with no penalty.
So that's definitely a lot of good options to get in there and lock some things down and get that done. So yeah, I appreciate that. And then definitely a lot of good answers to the questions that we get a lot of times from the clients and just wondering about things. So, if you want, of course, to get fully pre-approved and ready to go, Sam's your guy, and we should definitely get you in touch with him. If you want to get our buyer's guide and, our checklists on what you need to do and help things out, make sure you click on the link below and check that out. But yeah, thanks again, Sam, for everything you got. Anything else that you want to add or that I missed that you think that you get a lot of questions from? Because I know I probably only hear about half of them. But.
Well, you mentioned pre-approval, which, I think in this area, it seems like most sellers really prefer that the clients be pre-approved. You agree? So that's something worth, I guess, talking about. And so at Elevations, we do that for free and without obligation. But you fill out an application. We check your credit, you upload your bank statements, your pay stubs, your W-2s, whatever income documentation we need. We issue a pre-approval so that when you write an offer, a pre-approval letter accompanies the offer. And, since there's really no industry standard of what that means, what I hope happens is that the seller's agent gets my letter and calls me and say, hey, Sam, I got your pre-approval letter. What does that mean? What have you done? What have you documented? And so if I say, yeah, we've documented income, we've documented assets, we've documented credit, we've run it through, we got a pre-approval through the automated underwriting system, and we're just looking for a house, that's a much stronger conversation than, I talked to them on the phone and they sound great.
Yeah, definitely. We get that a lot, as listing agents, it's like, okay, well, where's this pre-approval from or pre-qual or what? Now, which one is this? So yeah, I definitely like going, and it seems like all the agents in town that do listings and things like that, they love seeing the letters from Elevations Credit Union because they definitely know that yes, that loan will close if it is approved with that. Another thing that I really like is I always let and send over the listing agent's information to you so you can give them a call for us and for our clients and introduce yourself. And I really like how you definitely go above and beyond and help put in that final word on our offer in those multiple offer situations. So we definitely
Yeah.
get a lot more than most people, I think, when that happens because of that.
Well, it's such a competitive market here. I mean, being a buyer in this area, it's hard, right? It's a battle of persistence. So anything we can do to kind of raise the level of the buyer in the eyes of the seller, we'll do that.
Yep.
Try to help out.
It helps. Perfect. Well, I appreciate
Okay.
your time, and I'll let you get back to that stack of papers I'm sure you got, or emails, I guess nowadays to
Sure.
keep on with those loans. So thanks again for everything that you do, Sam.
My pleasure. Thanks so much, Ryan. Thanks for having me.
You bet.